So it sounds like you've been around the block, seen many different areas across the investment spectrum. And actually quite interesting as well is you've been part of the big infrastructure, you've been part of the small infrastructure, and you've kind of like had these ups and downs in your career where you've had quite a few moves and kind of been there, seen it all, done it. Mm-hmm. I think an interesting perspective might be the difference between, or the main differences between that long-only infrastructure that you had at the beginning of your career and what you had around you then, compared to the smaller funds that you've worked at in the past. What are the main differences, you would say?
You know, between Franklin Templeton and GSA, they're both giant firms. TradeWinds Global was pretty big as well. Hedge was small. I worked for other couple of firms that I didn't even bring up in between that were also, you know, on the smaller side. So yeah, so I've been kind of working for a bunch of different size firms and traded a bunch of different asset classes. And I think the difference is when you're a giant fund, you're kind of, you have your hands tied quite a bit because of liquidity constraints and opportunities. You know, like if you're trying to trade billions of dollars worth in, I don't know, in small cap stock in Malaysia or some other country, it can be very, very difficult to get into that position. It might take you months. And to get out might take you months. So by default then, the holding periods for these big guys just has to be much longer. And there would be, you know, 5-7 year holding periods. And for a smaller fund can be much faster. And a smaller fund has more flexibility to move around in other, you know, asset classes or maybe smaller companies that bigger guys don't have access to. So, you know, plus that the whole compliance that goes around, you know, a big, you know, trading desk in a big firm is much more intense. So it's yeah, it's a bit of a, you know, it's a bit of a different world. I think I prefer the smaller funds.
So it's kind of like the super tanker and the speedboat, right? It's like how long does it take to turn around a super tanker? A speedboat can just zip around and be in and out, right? And I get, it's like the difference investing and trading. I mean, if your time horizon is 5-7 years, you're not trading really.
Right. I mean,
it's investing.
It's, you know, and a lot of the trading you do on a trading desk for a big firm is it's basically trading in and out of positions, like, or trading actually, as you say, around positions. Yeah. So you have a big position, you might take some chips off the table, you might add to it. You know, probably, you know, at least half your trades or more are basically trading around current positions.
So you have these like core positions that last for years. Right. But you're basically overweight, underweight, and neutral in the portfolio relative to other positions.
Yeah, that's
trading around the core positions.
Yeah, because, you know, to put on a new position for a big firm is actually kind of a big deal. I mean, it has to get approved by, you know, the investment board or, you know, whoever. It's like it's a process. You can't just have a guy who says, "Oh, gee, I think I'm gonna just punt in this little company in Vietnam, see how it goes." Right. It doesn't work like that. There's a lot of process. Yeah. You know, there's a lot of people involved. There's a lot of hoops to go through before that order actually ends up on the trading desk.